2025 has been a wild ride. If you held the right ETFs, especially in tech, you probably made good money. But here is the hard truth. Making money is easy. Keeping it is the hard part. While you are planning your New Year's Eve party, your portfolio is sitting there, vulnerable. Right now, as we speak, there are silent killers lurking in your portfolio. There are tax liabilities you don't see coming. There are concentration risks that have quietly built up over the last 12 months. And there are specific IRS deadlines that are set in stone. The deadline is real. You have until the ball drops to fix this. If you wait until January 2nd, 2026, the door slams shut. In this video, we are breaking down the 5 critical money-saving ETF strategies you need to execute right now. We are talking about the wash sale trap, the dividend mistake that hands you a tax bill for nothing, and the winner's curse that could wipe out your gains. Do not click away. This is the difference between a good year and a great year. Let's get to work. Strategy number 1, the Smart Swap protocol. This is the single most powerful tool for lowering your tax bill, yet most retail investors are too afraid to use it. I'm talking about tax loss harvesting. Here is the reality. Even in a bull run, not everything goes up. You likely have some ETFs or stocks in your taxable brokerage account that are bleeding red. Maybe a specific sector fund or a bond ETF took a hit. Most people look at those red numbers and think, I'll just hold on. That is an emotional reaction, not a financial one. The IRS allows you to sell those losers to realize a loss. You can use that loss to cancel out the capital gains tax you owe on your winners. Even better, if your losses are bigger than your gains, you can use up to $3,000 of those losses to offset your ordinary income, your salary. That is real cash back in your pocket. But, and this is massive, you have to navigate the wash sale rule. The IRS says you cannot sell a security for a loss and buy a substantially identical one within 30 days. If you sell a losing S&P 500 ETF and immediately buy another S&P 500 ETF, the IRS will disallow your loss. You get zero tax benefit. So, how do the pros do it? We use the Smart Swap. You sell the losing ETF and you immediately buy a correlated but not identical ETF. For example, sell your losing S&P 500 ETF. Do not buy another S&P fund. Instead, buy a total stock market ETF. Why? Because they perform almost identically. If the market goes up, you still win. But because they track different indices, they are not substantially identical to the IRS. You capture the tax loss, but you keep your money working in the market. It's the perfect crime, and it's 100% legal. Strategy number 2, avoiding the dividend trap. This strategy bites investors every single December. You might be looking at your portfolio thinking, I have some extra cash, I'll buy into this ETF before the year ends. Stop. Check the distribution schedule first. Many ETFs pay out capital gains and dividends in late December. If you buy an ETF the day before it pays a dividend, you fall into the trap. Here's what happens. The ETF pays you the dividend. The price of the ETF drops by the exact amount of that dividend. You have zero net profit. You just got your own money back. However, the IRS considers that dividend as taxable income for 2025. You literally volunteered to pay taxes on money you didn't earn. If you are planning a large purchase this week, check the fund's website. Look for the ex-dividend date. If it's happening this week, just wait. Buy the fund on January 2nd. You'll get it at a lower price after the distribution and you won't have that annoying tax bill attached to it. It's a simple delay that saves you money. Strategy number 3, the winner's curse and rebalancing. Now, let's talk about the danger lurking in your success. This is psychologically the hardest thing I will ask you to do. Look at your portfolio. Go back to the plan you made in January 2025. Maybe you wanted a balance split, say 20% in tech, 20% in healthcare, and so on. Because 2025 was such a massive year for tech and AI, your portfolio is likely warped. That 20% tech slice might now be 40%. You didn't add money to it, it just grew. You are winning now, but you are carrying way more risk than you signed up for. If the tech sector corrects in early 2026, your portfolio will bleed twice as fast as it should. You need to execute the winner's curse maneuver. You need to sell the assets that have done the best, selling high, and use that money to buy the assets that have lagged behind, buying low. I know it feels wrong to sell the winner, but markets move in cycles. By rebalancing now, you are locking in those massive 2025 profits. You are taking chips off the table, and you are moving that capital into sectors that are statistically cheaper and have more room to run in 2026. This is how the wealthy stay wealthy. They don't chase the hot thing, they rotate their profits. Strategy number 4, the Legacy Audit. For my viewers who have been investing for over 10 years, this is for you. We need to talk about expense ratio creep. Years ago, an inexpensive ETF cost 0.50% or 0.75% per year. You bought it and forgot it. But today, you can get a total market ETF for 0.03%. If you are still holding a legacy fund charging 0.75%, you are being robbed slowly. Over 20 years, that fee difference could cost you tens of thousands of dollars. Strategy number 4 is the Legacy Audit. Log in and look at the fees of your oldest holdings. If you have a high-fee fund that is sitting at a loss, sell it immediately. Get out. Move that money to a modern, low-cost equivalent. If it has gains, do the math. But often, if you have other losses to offset it, remember strategy number 1, this is the perfect year to clean up your portfolio. Get rid of the dinosaurs. Streamline your holdings into the low-cost ETFs that dominate the market today.
Strategy number 5, the 2026 Autopilot Reset. We have done the hard work. We harvested losses, avoided dividends, rebalanced, and cleaned up fees. Now, let's look forward. The IRS has announced new contribution limits for 2026. Your 401k limit is going up, your IRA limit is going up. Strategy number 5 is a system upgrade. Log into your payroll provider or your brokerage account today. Adjust your automatic contributions. If you are saving $500 a month, bump it up. Here is why you do it now. If you wait until March to increase your contribution, you miss 3 months of compounding on that extra money. Time in the market beats timing the market. By setting your automation to hit the new maximums, starting with your very first paycheck in January, you are front-loading your success. You make the decision once, so you don't have to make it every month. Listen, I know this is a lot. I know you'd rather be relaxing. But this is the difference between an investor and someone who just buys stocks. An investor manages the machine. An investor looks at taxes, fees, and risk. If you do these 5 things, harvest your losses, avoid the dividend trap, rebalance your risk, audit your fees, and automate your 2026 goals, you aren't just closing out a year, you are building a fortress around your wealth. You can go into that New Year's Eve party, raise a glass, and know with absolute certainty that your financial house is bulletproof. This is my last video for 2025. It has been an incredible journey with you all. I want to thank every single one of you for watching and trusting me with your time. We are building something massive here, and 2026 is going to be our best year yet. If this video helped you save even $1 of tax, hit that like button so the algorithm shows this to more people before the deadline. Have a wonderful, safe holiday. Enjoy your family. And I will see you in 2026.